Welcome to the CI Brightworth fourth quarter investment update. My name is Don Wilson. I'm our Chief Investment Officer. Joining me today are two members of our investment team, Nick Fazio and Mike DeWitt. Guys, it was a difficult year for both the stock market. We had a bear market, and it was arguably the worst year for bonds in history. And yet we did see a strong recovery in both in the fourth quarter. And so today we're going to talk about some of the things that took place in 2022 and also in the fourth quarter. We'll talk about, this is kind of the time of year where you're getting all kind of predictions from all of the financial punditry. So we'll talk about those predictions and how we think about that and how we invest for our clients. And we'll also talk about what may be the biggest question on the minds of investors today, which is after a tough year for the stock market, where do we go from here? Is there more of the bear market still to come, or are we past it? And so, Nick, why don't you start us off and talk to us about some of the things that happened last quarter and last year.
2022 was an extremely challenging year for markets, though we experienced a great rally in the fourth quarter across most asset classes. The S&P 500, which at one point in the year was down as much as 25%, actually climbed almost 8% in the last quarter to finish the year down only 18%. And small cap and international stocks returned around the same level. This was a historically down year for bonds, with the core bond index experiencing its worst annual return on record going back to the early 1970s. And bonds that were more sensitive to changes in interest rates were affected the most, as shown by the 30% decline in long-term government bonds. As a reminder, we typically stay away from investing in these types of bonds for this very reason. Credit risk, on the other hand, performed slightly better than interest rate risk this year, which is why high-yield bonds performed a little bit better on a relative basis. Now, I'd like to walk through three quick observations that we noticed in 2022. For the better part of the past 15 years, U.S. stocks have outperformed international stocks. Outperformance typically goes back and forth in cycles, and this has been a particularly long period of outperformance in one direction. In 2022, however, international stocks actually outperformed U.S. stocks. A lot of the losses that we saw this year are not actually from the international stock performance themselves, but rather the impact of investing through the U.S. dollar, which we're accustomed to. When you exclude the impact of the U.S. dollar and you focus instead on the returns gained in their local currencies, international stocks lost only 10% on the year, handedly beating the performance of U.S. stocks by 8.5%. While it's natural for us to focus on an economy that we're familiar with and brand names that are familiar to us, it bears remembering that there's a lot of quality businesses that happen to be located outside the United States. We continue to think it's important and prudent to be able to still have exposure to those types of investments. The second observation was that it wasn't too long ago that all anyone could talk about in the markets was FANG, that basket of stocks including Facebook, Apple, Amazon, Netflix, and Google. These are some of the best businesses on earth and had historic runs in the stock market in the past several years. And it got to the point where many were wondering, why would you invest in anything else? Well, as you can see on this chart, 2022 was a bit of a different story, with that basket of stocks returning 43% for the year, which is a significant decline relative to the S&P 500's 18%. We think main messages that come from that. Number one, just because it's a quality business, and these continue to be great businesses, does not always mean that they're the best investment, especially depending on what kind of valuation you purchase the security at. And number two, diversification continues to be very important in any investment strategy. You may feel like you've split up your risk with 5 or so companies, but having exposure to all sorts of different sectors like energy and utilities and consumer staples can really help limit your downside when we experience periods of volatility like we have right now. Lastly, diversification across bonds and stocks didn't really have the outcome that we typically expect in investing in 2022. The traditional 60-40 portfolio had its third worst year on record, which has led many in the media to wonder if the 60-40 is dead even. We think that over time, the benefits of diversification will continue to appear, and that this was more of an outlier than any kind of new normal. A big reason for why we think that this portfolio is going to do better in the future is that bond yields have risen dramatically since they did at the beginning of last year, and that should be able to buffer any kind of future volatility or headwinds that we may see in the future. So Don, it's been a historic year in fixed income. Can you tell us a little bit about what's going on in the bond market?
It has been the worst year for bonds in history. Looking back since the index started in 1976, and take a look at this chart. Each of these bars represents the return for 1 year for the bond market. Most of them are above the line, and there's really only been 5 negative years going back to 1976, and most of those were down just 1% or 2%. If we look all the way to the far right, 2022 really stands out as an outlier as core U.S. bonds fell 13%. What's interesting though, many people have attributed the very bad year for bonds last year to the Federal Reserve's aggressive rate increases. Those increases continued in the fourth quarter of last year, and yet bonds, unlike the first 3 quarters, were positive. Bonds were up 1.9% in Q4. Why is that? Why, even though the Federal Reserve raised rates another 1.25% in the fourth quarter, were bonds positive? And for us to understand that, we need to look at something called the yield curve. Take a look at this chart, and this is a yield curve for U.S. Treasury bonds. And a yield curve simply plots the different yields for bonds of different maturities. And so for the far left, you have short-term bonds of 1 and 3 and 6 month maturities. And you can see their yields going up. And then on the far right are longer-term bonds, so 10 and 20 and 30 years on the far right, and the yields that are available for those bonds. What we know about the Federal Reserve interest rate hikes is they're actually hiking very, very short-term rates. It's called the federal funds rate, and this is the rate that banks charge each other to lend money from one bank to another overnight. So it's a single one-day maturity bond. And so when the Fed raises rates, it really impacts short-term bonds. It doesn't directly impact longer maturity bonds in the same way. And so take a look at this second chart. And on this chart, we still have the 9/30 yield curve. We also have the end of the fourth quarter yield curve now in red. And you can see on the left-hand side, the red curve is well above the blue curve. So the Fed's interest rate hike had a big impact on these short-term bonds, but in the intermediate and long-term bonds, there's really not much difference. And so the reason that matters is for the index and for bond investors who invested similarly to the index, most of the impact from bond interest rate changes comes in intermediate and longer term bonds. They're much more sensitive to rate changes. And so in this case, in the fourth quarter, even though short-term bonds went up significantly, intermediate and long-term bonds did not. And that's why, despite the Fed raising rates quite significantly in the fourth quarter, it was still a good quarter for the bond market. Now, what does that mean for investors from here? Well, even though the Fed is expected to continue to raise rates, there's a pretty good chance that that may not be the bad news for bond investors that many expect. It could be much like the fourth quarter of last year, where intermediate and longer term rates don't move, and now because of the higher yields available to bonds, it creates a great opportunity for investors who can now buy bonds yielding much more than they could have even just a year ago. So Mike, this is the time of year where we start seeing predictions really across the financial media. Talk to us about what we think and how we think about these predictions.
Yeah, Don, it's one of my favorite times of year. The experts are coming out of the woodworks to predict everything from who's going to be in and win the Super Bowl to certainly the financial markets. And as human beings, it's very natural. It's even entertaining and fun. And in fact, science tells us that it's wired into our DNA to make predictions. Recent research in neuroscience has laid aside the idea that we take in data from our five senses and use that to make our decisions in life. Rather, the brain is working all day long making millions of predictions that it then compares against reality to make adjustments and figure out what to do next. Now, this is interesting in the science field, but it has real implications as far as the investing world. For one, it explains why pundits are so apt to make predictions about everything. It also sells ads, by the way, very well, so that's a side benefit. But secondly, as individual investors, we have to guard against what we call recency bias. So we're taking these predictions and assuming that whatever has been happening in the recent past, whether it's good or bad, we'll extrapolate that, and our brain thinks that's going to keep on going into the future. And if we make decisions based on that, sometimes we can get into real trouble financially. Now, let's look at a few examples of predictions made throughout history that didn't turn out so well. There's many of them. So early last year, we know that Russia invaded Ukraine. And from an economic standpoint, one of the first predictions made was that the prices of oil and gas and other petroleum products, as well as the price of wheat, which is a major export for Ukraine, but the prices of those would go through the roof. Seems very natural and plausible and almost destined to happen. They did spike for just a time, but in fact, if you look now, the price of those commodities is lower than it was before the invasion. And that could be due to several things, probably a warmer than expected winter and fall period in Europe, also an increased supply of those commodities. But the point is, the prediction that seemed obvious didn't come true. So the next couple of predictions I'll share are due to what I call the curse of the magazine cover. Whenever something becomes so widely popular in the public that it hits the cover of the magazines, you can bet that it's usually already priced into markets if it has economic benefit. So this first one talks about technology stocks. Nick talked about them being the darlings of Wall Street for so long. Their prices have just gone through the roof. Well, back in August of 21, this cover proclaimed the unstoppable rise of the tech stocks, which is humorous unless you're really invested heavily in them, because the next year we saw that what I call the tech wreck in 2022. Unfortunately, the market caps of a lot of these stocks were just really decimated. This next magazine cover shows a fellow that's not as widely known to everyone, although unfortunately he's becoming more widely known. Sam Bankman-Fried, the founder of the cryptocurrency trading firm platform called FTX. This cover asked whether he was the next Warren Buffett, and this was just shortly before he was arrested and his firm was accused of perpetrating perhaps one of the largest frauds in U.S. history. So I feel like he's probably not going to be remembered as the next Warren Buffett. This next one, back in 2019, magazine asked if we are witnessing the death of inflation. It felt like it for many years. Inflation was very low, even dipping negative. Interest rates very, very low. And then lo and behold, last year we experienced headlines that say we're having the highest prices we've seen in 40 years. I'll give them credit. It took a couple of years, so it looked like inflation maybe was dead for a couple of years until it wasn't. Now we're seeing these higher prices. Finally, one of the most probably famous magazine covers that cost many investors countless millions, if not billions, if they acted on it, which was the 1979 cover of Business Week that declared the death of equities. And this was just on the eve of the beginning of the longest and strongest bull market in U.S. history, covering the majority of the 80s and the 90s. Successful investing often requires counterintuitive action. If everyone agrees on everything, then it's probably priced into the markets already, because the markets are pretty efficient most of the time. Now, some of these pundits will get their predictions right some of the time, but very few, if any, throughout history have been able to do it consistently enough that it's worthy of taking action on their predictions. While it can be entertaining and even fun to listen to the predictions, and it's certainly wired into our human nature, our advice is to turn off the pundits ignore the majority of the predictions being made about the markets and the economy and focus on the things that you can control. So guys, previously we've talked about why we don't use short-term pundits at making predictions and managing our clients' portfolios. I'd like to talk a little bit how we do manage portfolios, and for a little fun, we'll do it in the context of a couple of predictions that are being made right now. So one making the rounds is the narrative that inflation continues, the Fed keeps hiking interest rates, that tips us into recession and stocks have to fall. The second is the question that comes up every year at this time, hey Mike, what is the stock market going to do this year? Now, with regards to the economy, there's the old joke that economists have predicted 10 of the last 5 recessions. They often predict them, they usually don't happen. This year is a little unique in that they're almost unanimous in their prediction of recession. And maybe we'll have a recession, maybe we won't. The famous economist John Maynard Keynes said, the inevitable never happens, it's always the unexpected. And this is the very definition of risk. And we could point to any number of things that could happen that help us avoid a recession. Maybe we just have tepid growth, but not the technical definition of a recession by the government. Maybe Washington gets its act together. Maybe inflation turns around. There's some signs of that beginning to happen. Hopefully we'll have a resolution peacefully to the Russian-Ukraine conflict, and that might have a positive impact. But regardless of what happens in the economy, you should think about this as a stock investor. Historically, since World War II, during the 12 recessions we've experienced, stocks actually went up during 6 of them, so half the time. And in every single case, stocks were higher 1 year after the recession. History is no guarantee, of course, but that's some pretty strong historical evidence. Finally, for a little fun in politics, the year after a midterm election has been positive for U.S. stocks every time so far in history. We'll see if that holds. But the message is we want to own stocks and we want to own them for the long run. Stocks have historically been the best way to grow and preserve capital regardless of the ups and downs and the inevitable recessions that we'll experience from time to time. Now let's take that second question everyone's always interested in. What will the stock market do this year? Well, it's the time of year when the experts come out making their predictions we've been talking about. This one shows you all of the global or many of the global investment banks and their predictions for last year where the S&P would end up. Now, the S&P started at about 4,800. It ended around 3,800. That's a loss of nearly 20%. If you take the average of all these experts, they were expecting a gain of 4.5%. A couple predicted a slight loss, but nowhere near the magnitude we actually saw. Now you might think, well, that's a one-off year, we're cherry picking that, but unfortunately, if you look back over the last 20 years, you can see that while they get it right every now and then, they're close to the actual results of the market. You can see that in 2002, they were off by over 40%. In 2008, they were off by over 50%. We know they were off last year. We just looked at that. And so unfortunately, this is the case when we look at individual stock predictions as well. We've talked in past videos about some of the darlings of Wall Street recently. Tesla, expected to be a major player in the global auto market, is definitely making headway, but at one point it was valued as one of the 10 largest companies in the entire world. It certainly has not made that kind of headway if you look at its sales or particularly its earnings. And that stock is down over 70% from its recent high. Another one that experienced just tremendous gains for a time is Zoom. Many of us have used that technology with great benefit during the pandemic to conduct meetings remotely. That stock is still around. The company is doing well, but the stock is down over 80% because of its lofty valuation. Finally, I'll mention Bitcoin because we've talked about cryptocurrency today. Many experts thought and still do think that Bitcoin will one day overtake the US dollar or the yen or the euro as the global reserve currency. Maybe that will happen, maybe not, but as of right now, Bitcoin's price is down over 70%. So if you took any one of these 3 examples as an expert prediction of what was almost inevitable, the confidence that they predict them, you would have been in real trouble if you concentrated your investment there. So our outlook for stocks is the same as it is most years. It's that stocks will probably go up, but they might go down. And if that sounds trite or useless even, I'm sorry, but it's actually pretty good advice. Any given year, the chances are about 2 in 3 that stocks go up. You can see from this chart that historically this has been the case no matter who's in the White House, no matter whether stocks went up or down last year, the odds are about 2 in 3 that stocks will go up. And we prefer to be pretty accurate with a non-specific prediction like that than to be really specific and be wildly inaccurate, which happens a lot of the times with the individual stocks. So as it relates to our clients' portfolios, instead of saying, well, we know X is going to happen, so therefore we'll do Y in the portfolio, we prefer to think about multiple scenarios that could happen and position our clients' portfolios such that no matter what happens, they're in a good place to grow and protect their wealth. And some of the ways we do that, including diversification. So diversification is a long, time-tested method that helps us avoid the catastrophic losses that can come if we're not otherwise doing that. We are rebalancing thoughtfully. When stocks go up, we trim them. When stocks are way down, we add to them. This helps us systematically buy low and sell high in your portfolios. In certain portfolios, we make periodic tactical moves, shifting assets around when things look way out of whack from their historical norms. We're constantly striving to upgrade our portfolios for clients. So sometimes an asset that's been performing just fine, we find a better alternative or one that we think has less risk going forward, and we'll upgrade the portfolio. And finally, we try to focus on the things that we can control. That includes the risk we're taking for an individual client, depending on their financial circumstances. It includes controlling our behavior and our emotions and helping our clients do the same when the markets are inevitably bouncing up and down. And it includes controlling taxes and costs and other expenses the best we can. All that may sound simple, but it's fairly hard to do. It takes discipline and patience, and fortunately we have decades of experience helping shepherd our clients' money so that you can focus on what matters to you most. So Don, we've talked about predictions, how we use and don't use them in client portfolios. We're really in what I would call the middle of a bear market here. We had a terrible year for the stocks last year. Why don't you and Nick tell us why we might or might not see an end to that bear market?
After 2022, perhaps the biggest question on many investors' minds today is, where do we go from here? Is the bear market behind us, or is there still more to come? And while we don't make short-term predictions about where the stock market is going, it doesn't mean we don't think about what could cause the bear market to end or what could cause it to continue. And so I'll talk about 3 reasons why. First, the bad news, the bear market may not be over. Then we'll get to the good news of 3 very good reasons why the bear market may in fact have already come to an end. So first, the bad news. Number 1 is an adage, don't fight the Fed. This is often something you hear when the Fed is easing monetary policy, when they're cutting rates, when they are increasing the money supply, which oftentimes helps the stock market. And take a look at this chart. This chart looks at a measure of money supply called M2. And when this line is higher, that means the money supply is growing faster. When it is lower, it means the money supply is growing slower. And right after the pandemic, the Fed really pumped up the money supply. And you see that had a very positive effect on the stock market, on risk assets overall. But since that time, the money supply has come down sharply. And in fact, today, it's actually slightly negative. So in the same way that it was a positive for the stock market, having money supply now contracting slightly could be a reason for the stock market to have a headwind here in the future. A second reason the market could have a headwind gets down to earnings. Right now, most economists expect that there will be a recession in 2023. Whether or not that happens remains to be seen, but looking back at the last 12 recessions, going back to World War II, on this chart we see that during recessions, earnings tend to fall a median of 13%. So if we do get a recession, it's likely we'll see earnings contract, and that could be a second headwind for the stock market. Number 3 gets to valuations. Valuations, as this chart shows, really bounce around a lot over time. And so you can see the black line, which measures a smooth price to earnings ratio for the S&P 500. It's trended higher, as the dotted blue line shows, but doesn't really spend a whole lot of time near the trend line. During bull markets, it's usually shooting up well above the trend, and during bear markets, it often goes well below trend. That was the case in this prior bull market, where we saw this valuation measure go above trend. During 2022, it has come back down near trend, but if it goes further, as it has in some bear markets in the past, that could be a third reason why the bear market might not quite be over. So those are some negative reasons, but on the positive side, I think there's some really good reasons why the bear market may in fact be over. Nick, talk about some of those.
Sure, Don. And after a year where the S&P fell about 18%, it's natural to feel a little sour about the market and maybe feel like bad times may continue. But there are 3 reasons that I feel are pretty strong for why the worst of what we've seen in this downturn may already be over. The first reason is, as we've talked about in different segments, in different videos, everyone thinks we're going into a recession. If you look at this sample of headlines, for the better part of the past 6 months, financial media has been talking constantly about when, not if, we're going to go into a recession. And they may be right. These headlines are from very reputable, smart media publications. But it is fair to say that the view that we're going into a recession in 2023 is consensus. And consensus thinking isn't necessarily wrong, it could be right, but consensus is just what's already priced into the market. Asset managers and those managing large sums of money, they don't wait for an official declaration by a government agency that a recession has come, or that any sort of news has occurred, before they go ahead and put their views by investing on what they think is going to happen into the market. So if a recession actually does materialize, there is a chance that the market doesn't decline much further, because everyone's already saying a recession is going to happen. So they've already positioned themselves accordingly. Alternatively, if the economy is able to avoid a recession and have a so-called soft landing, which the Federal Reserve still believes is a possibility, then the market could actually rally based on reality being better than what people are currently perceiving it to be. The second reason the bear market may be over has to do with consumer sentiment. So if we look at this chart, the data that you're seeing comes from a poll that's taken by the University of Michigan each month that asks consumers how confident they feel about the near future and how they think they're going to spend in the near future. Historically, consumers tend to be most confident towards late stages of economic expansion and stock market rallies, and they tend to be the least confident when there's higher amounts of fear in the news, be it because of economic pain or contractions, or just stock market declines without a commensurate decline in the economy. If you take a look at how the stock market behaves 1 year after these various points, you tend to see that it's a slightly worse time to invest in periods where consumers are extremely confident, though still positive. But on the flip side, it is a very good time to invest when consumers are at their most pessimistic. It's a little too early to tell, but if sentiment reaches its low point towards the end of 2022, like we might have seen, then we may be poised for stocks to climb higher in the near future. The third reason that the bear market may be over is that history is actually on our side. Looking at this chart, there's been 16 years since the end of World War II where the S&P 500 had a negative return in a calendar year. And in 13 of those 16 occasions, the following year was positive for the S&P 500, and in many cases very positive, over 20 or 30%. So we don't know what 2023 is going to hold. However, if we're to use the weighty evidence of history, it could be a pretty good year. So these are 3 reasons that we feel that the bear market could already be over.
Okay. Thank you, Nick. Thank you, Mike. And thank you to our viewers. We hope that you found this informative and insightful. For those of you who are clients, feel free to reach out to your advisor if you have questions or follow-up. And if you're not currently a client but you'd like to learn more information, you can find more on brightworth.com. Thank you.